Welcome to the Money to the Masses podcast, putting you in control of your finances. One is an expert with years of experience giving free advice. The other owns his own microphone and can do the odd bit of editing. Here are your hosts, Damien Fahy and Andy Leeks.
Now, Damien, before we get on with this week's podcast, you had something quickly to say about our sponsors.
Yeah, we've got a new sponsor, Money Farm, and Money Farm are an online investment advisor and one of the biggest digital wealth management companies in Europe. So a big thank you to them for sponsoring the podcast. Now, Money Farm create portfolios to maximise long-term returns using ETFs to make incredibly cheap portfolios. And you even get the first £10,000 of your portfolio invested without any charge from Money Farm. And if you enter the code MTTM20K into the box when you sign up, you get the first £20,000 of your portfolio invested and run by moneyfarm.com without any charge.
Great stuff. On with this week's show. Hello and welcome to episode 98 of the Money to the Masses podcast with your resident expert, as always, Damien Fahy and me, Andy Leeks. Damien, how are you doing?
Good, Andy. I'm refreshed. I've had a week's holiday. As no doubt everybody knows who's listened to the podcast, they've been pining because you and I aren't here, or weren't here last week, but no, I'm feeling good.
Good, you're looking good. You're looking good. You look like you caught the sun, even though it was a bit of a, what was it, a staycation?
We did a staycation. We went to just round sort of near Windsor way and did a load of activities with the kids. You know, just basically did the tourist thing. It was brilliant. Did the Go Ape, swinging in the trees, seeing the Windsor Castle, all that stuff. So the kids loved it. And yeah, it was great. It was great to have some time with the family and all that sort of stuff. And as you say, catch a bit of English sunshine.
Did you, be honest, did you turn the phone off for the week? Did you turn off the iPad, the laptop completely, or did you dip in and out?
Do you know what, Andy? I tried my hardest. I was good. For the daytime, I would not have the email, I wouldn't do anything. But the problem is, I've said to people on the podcast, look, if you send a message to me, it pings through on my phone, and it
so
does.
You were a man of your word, basically.
Yeah, so there were times that I was responding to people, 80-20 investors, people from the podcast. I did keep it to a minimum because I can't really turn around and say to people, hey, I'm on holiday. Although Martin Lewis did do that, interestingly.
Did he?
He's taken the whole of August off, but which fair play to him. But then after the years he's done it and the money he's made, he can afford to take the whole of August off. Anyway, so yeah, I did my best. And yeah, it was good. It's nice to have a break, and I'm back.
You're
refreshed.
Back. You've got colour in your cheeks. Your beard's growing that little bit longer, and it's lovely to have you back. What have we got coming up on the show?
Well, this week I'm doing a bit of a behavioural science piece. So there's a couple of pieces about behavioural finance, and there's one about how investors underestimate their financial losses, which actually leads them to probably make more than they should do. I want to talk a brief bit about an interest rate cut on a very, very popular account. I'm only going to touch upon that because it will affect a lot of people, actually, because it was a very popular product. And I also want to talk about another piece of behavioural work done by another very clever person with a PhD around the 6 psychological tricks that drive frauds, so enable people to scam you of your money. So things to look out for, and it's also, interestingly, what drives a lot of sales tricks and tactics. So when you go somewhere and they try and flog you things. So I want to touch upon that because it's been given a bit of an airing, and I like it, quite frankly.
Sounds like there's a very small divide between legal and illegal activity in terms of the psychology on how people fleece you for money.
Do you know what, Andy? We'll come on to it, but it's exactly the same. Yeah. It's just
one side of legal and the other side.
The means to the end are the same. It's just what the end game is. One is probably selling you a car. The other one is probably scamming you of that car or your money. So
Good
we'll
stuff.
do that, yeah.
We'll save that for last. That sounds good. Not that the other stuff doesn't sound good.
Oh, God, Andy, I've missed you. What? Before we carry on, what have you been up to since I've been away?
Much to my wife's annoyance, I bought myself a bike around about 10 days before my birthday. So
a push bike?
Yeah, push bike. I got inspired by the Olympics and decided to Yeah, a lot of my friends in our local village and area, we live in a beautiful Kent countryside, and I got a bit jealous of my friends that are getting out in the evenings and getting out on the bike. And so I made a purchase of several £100 just before my birthday, which didn't go down very well.
Well, I think you deserve it, Andy. Treat yourself. Have you ridden the bike though? That's the big question, because you are a man who lives his life by impulse and has been known to purchase cars that he's never driven.
That is true. No, I can ride a bike, albeit not very
No,
well.
I didn't ask if you can ride a bike. Have you ridden the bike you bought?
Oh yeah, no, I've been out a few times on it.
Oh, good,
six or seven times, and I've got an app. Of course, me being me, I bought all the technology that goes with it, and so I've got an onboard computer.
So we're going to see you in the velodrome in Tokyo.
You might see me in there. I'll be the one at the back waving a flag. Yeah.
Brilliant. I'm impressed, Andy. I mean, I need to do something like that because I don't do any exercise at the moment. I just sit there and do. Well, I'm sitting on my bum doing this podcast. That pretty much sums up my life. But anyway, shall we crack on?
Yeah, let's do it.
Actually, before we do the first piece, I'm going to throw in another piece that we're going to do right now on investing. And it was inspired by 80/20 Investor, which, as regular listeners know, is my DIY investment service that we do. Is very successful. We teach people how to run money, help them pick funds. And my portfolio, by the way, is doing exceptionally well. It's up since it started in March last year, up about 14% versus a benchmark for the market of 6% from the FTSE and around about 8% from a typical professionally managed fund. So I just get that in there. So I am pretty pleased by that. If I was American, I'd say I was stoked. Yeah. But what I wanted to do, it's actually a question I've been asked before about the number of funds you should have. And in my portfolio of £50,000 that I run, I try and have between 7 and 10. And I got asked an interesting question. If my portfolio was £500,000 rather than £50,000, would my portfolio be any different?
Okay.
And it's a question that people out there probably ponder themselves if they're fortunate enough to have larger sums of money. And the answer is no. Because one of the flaws of people, when you look at people's portfolios, when you work in the world of financial advice, they come to you and they have a portfolio that will be 20, 30 funds. It's like people when they collect things, they start off and they end up getting more, and they end up being so unwieldy they can't really see what's going on. And there's a lot of duplication because a lot of fund managers end up just almost tracking their benchmarks. So you don't need to have 5 UK equity funds. So the point
I'm following this because recently I've watched someone on the roulette wheel, on the roulette table, and it seems to me that the more money they get when they were on roulette, the more of the table they tend to cover, and then the more out of control their gambling is. I like the people that go in there with a game plan and a strategy, albeit it's just gambling. We're not talking about investing here. And they put it on certain numbers and they know where they're at. They know the odds and they know what they're going to win.
But I think that's, like you say, it's gambling, not investing. But there is definitely a parallel there, because what happens is if you spread yourself, like I said, if you use the idea that you end up having a half a dozen funds from the same sector, because the managers tend to follow the herd, that's what happens, because they don't want to veer off, because they're always benchmarked against their peers, and that actually leads people to not want to follow their convictions, because if they get it wrong, then they get hammered, don't they? And they lose money and ultimately their jobs. So what happens is that if you spread yourself around, the impact of an individual fund on the overall performance of your portfolio will be limited, because you've got so many of them. So if you've got 30, 40, 50 funds, then if one fund does amazingly well, it's going to make hardly any difference. So the idea is you need to back your convictions a bit more. 10, I feel, is a good number. If you go to really large sums, you might want to increase it a bit more, but don't go become one of these people who suddenly has about, like I say, 30, 40 funds. You'll get people who have portfolios, regardless of the size, that have that many, because they feel more comfortable. They think the more money I put in, the more funds I should have. Don't do that. Keep it simple, because then you can easily see the things that are outperforming, underperforming, and make changes accordingly. So the upshot of all that is try and stick to a sensible number, because you can manage them. And therefore, if a fund manager, you really are managing to pick the winners and the good funds, you will see the upside much more than if you were spread. Of course, if you get it wrong, there's the downside, but that is the wonder of investing. And the idea is that I've used that for how I run a 50k portfolio on 80/20 Investor, and it's the way that when I was back in the city and we building portfolios for people with millions of pounds, it was the same principle that I tried to drive home then.
Yeah.
And I know that some people, managers and financial advisors, will try and do more and spread their risk, but that's because, like I say, they're not back in the conviction. So that was just a quick piece, but very important. I mean, for lots of people, DIY investing, they're new to it. Don't feel like you've got to keep getting more stuff. So the next piece I want to do is about poor maths and how it leads investors to underestimate their financial loss. And now this, again, is something for investors and how they view their portfolios. Because what happened is somebody did a piece of research, and the research looked at, we asked about 3,000 people 2 questions.
Okay.
And I won't put you on the spot to ask you, Andy, but I have no doubt you would pass with flying colours. But the 2 questions are, if there was a stock or a fund, so a share, that increased 10% in 1 year and decreased by 10% in year 2, and assuming there's no dividends or anything like that to cloud it, is the stock or the fund's final value equal to, less than, or more than?
It's less than.
Andy, if I had a buzzer and a boing noise, you'd have got that. It is less than. Because?
Yeah, because 10% of 100% is 110, and 10% of 110 is 11, which is less than 100.
The sheer panic in your eyes there.
Did you see? I was like a rabbit in the headlights, but I got there. My logic was correct. My workings, showing my workings audibly is far more difficult.
Do you know what? I've never seen Carol Vorderman do that on Countdown, but you were spot on, Andy, so that's the most important part. So the idea of this is that what people would do is they wouldn't appreciate the idea of how much their losses were, because they think, I go up 10% and then it falls 10%, they're actually where they are. But actually they're losing money, and therefore they underestimate this and it impacts their behaviour. Now, if you then do the same question, they ask the same question again, but they change the figures, they up them. So they said, okay, let's imagine the share or the fund went up 50% in 1 year, then fell by 50% the next year, and again, there's no dividend or income to cloud the issue. Is the fund, stock, share, whatever you want to call it, is the final value more than, equal to, or less than the initial value?
Isn't it 15% down?
Well, the idea is you're skipping ahead, but it's less than. You're right, because you're actually doing more than what most people do. So what would happen if you go up 50%? You'd go from 100 to 150.
Yeah.
And then if you're going to lose 50%, well, half of 150 is 75. So you actually end up being at 75% of your initial level. So that means you're 25% down. Now, what is interesting about that, from a man who loves mathematics, is that the increase, when people think about it, that we were talking about 10%, weren't we, in the first question, and 50% in the second question. So you think, again, simplistic maths is actually wrong, but you think, it's only 5 times the value.
Yeah,
the difference in the loss was 1%.
25 times.
It was 25 times.
Yeah.
And this is the key point, because when they asked this question, more than half of the people answered both questions wrong.
Right.
Then only 3 in 10 got both right. So you were in the 3 in 10, Andy, so well done. And 15% got 1 right and 1 wrong. They didn't actually have to work out the value. They just had to say whether it was less or more. Okay. So the point is that people underestimate that value. And so a bit like a gambler. You know, when gamblers, using that analogy again, is that people always sort of talk about their wins but not their losses. The point is, when you lose money, it takes you a lot longer to get it back. So like that point where you fell 50%, the amount you have to make again to sort of get back where you were, to go from that 75% where you ended up on that second question back to the 150, you've got to earn 100%.
Yeah.
And that is the biggest thing that people miss out on, and they don't realise. And so what happens, you underestimate your losses. And so for people who are starting to invest, they have to understand their capacity for loss. And what by that I mean their ability to lose money and be comfortable and not panic. So could they end up in that scenario, yes, you're up 50 1 year, down 50 the next, but then when you look at it, go, actually, I'm way down on where I started. And that's how you work out where you should be, and even if you should be investing. So I just wanted to chuck that one in as a bit of mathematics. Check your mathematics when you're doing investing, and hopefully you'll realise that you're understand what you're making and what you're losing.
Brilliant piece. I enjoyed that. No, that's very good. Well explained. What have we got next?
So the next piece we're going to do is, actually I'm going to jump ahead because that was about mistakes that people make. The next one I want to go on to is the idea of these 6 psychological tricks that salesmen use. And I like this piece because this came about, I read a book many years ago written by, another guy with a PhD. He's a chap called Robert Cialdini. I think I've said his name right. Apologies if I haven't. And he wrote a book called Influence, The Psychology of Persuasion. And in a nutshell, what this book did, it went through and explained how people sell things to you and the behavioural science and the psychology behind everyday things. For example, the idea of when you go... People, probably, it's a long time ago, but people you remember the Hoover people used to come around and they'll leave you a free gift and use the Hoover. There's a reason why they do that, and part of that reason is because if you get a free gift, there's a power of reciprocation that you want to do.
Feeling indebted to them.
You feel indebted to them, and that is a result of you being human, because we've evolved over millions of years to work as a society, and societies only work if you are able to do things like reciprocate. And there's basically a series of these behaviours we have that salesmen exploit and fraudsters exploit. And as I mentioned, Which did a brief bit of article on this, which is why I'm bringing it out, but they don't explain it very well, so hence why I'm doing a bit more on it. But the idea being is, we don't live on our own, we're not solitary creatures, and the reason we're not is because if we were, evolution favoured us living in groups, because if you were in the woods and you fell over and broke your leg, then you'd die. Whereas if you've got a group of people, they could help you and you survive. So that's why we evolved into having societies, and societies only work if we all work together. And these behaviours, like the one I've just mentioned, actually helps us to work, and everybody's happy, and we as a species move forward.
Yeah.
So what they've done is, there are 6 of these behaviours, which I'm going to rattle through, and I just want people to listen to them and listen out for examples, or sort of think of examples as I say them, of where they might come across them. And when they go through life and they encounter, whether it's emails or they walk into a shop to buy something or things they receive in the post, try and pick out which one of these things they're trying to use to actually use your human behaviour against yourself. So the first one is authority. And the idea behind that is people tend to obey other people that they perceive in positions of power. So from a scammer's point of view, they might send you emails or something like that have the words official or posed to be from the taxman. That's a good example. Do you remember around the end of the tax year, there was always a flood of HMRC tax scam emails where they're trying to get your details and then rob you of your identity. So that's an example of authority. Now in the real world, that we would like to follow people in authority, so salesmen use that in some way by trying to validate it in some way by making it official with the Queen's emblem or whatever it is. So look out for that. That is one way they might try and scam you. The next one is commitment and consistency. So once you're committed, people tend to be consistent and respond to consistent messaging. Now, that's a definition. Consistency, actually, I think this is probably one of the most powerful. If, for example, you decide on, I don't know, let's say, Andy, you say Watford, your favourite team or the best team in the world, and
They are, but yeah.
And I'm a Tottenham fan. The fact is, once you know your colours to the mast, it's human behaviour that we won't tend to change them. So you'll be a Watford fan for pretty much forever. I will be a Tottenham fan. But if you even think of examples whereby you are not so something you might inherit, like a football team or something like that. If you go something very recent like Brexit, now the referendum, there were people arguing still about the referendum, whether they will leave or remain, because once they made a decision, they can't. It's very hard for them. It's human behaviour. It stops you from actually going back and saying, no, actually, I'm going to change my mind. You have to be seen to be consistent, and the reason that is because if you're in a group as we are in society as an animal, if someone's going to do something, then the others are relying on that to happen, and it can only be for the benefit of the group, and the group can benefit if that person is consistent. So let's think about when the cavemen were going foraging for food. If the idea that person was going to go and do that and come back, that consistency, because they were going to do it, is how we survive. So it's that idea of consistency that they will try and exploit. So once they get you to either agree to something, they would get you to try and. There's a good example in the World Wars where they actually got prisoners of wars to POWs to actually write letters back to their own country saying they loved the Japanese, etc., etc. And it was like propaganda. And if someone starts writing it down, you become consistent. So what they'll try and do is get you to commit to something, and you won't want to. So whether it's a free trial or something like that, once you show an interest, you can't go back. So they will get you in the showrooms and things like that. So consistency is one to watch out for. The next one I would say is liking. If you like somebody, then it's much more likely you're going to trust them. So if somebody who's trying to get you to like them in some way, so even I suppose in the modern world, social media and stuff like that, you can very simplistically liking on those sorts of things, but they will try and use that to scam you. The other ones are social proof. This is a good one. So social proof and consensus. So things like, well, look at the idea of TripAdvisor, all these things. Anything that's got reviews and people say is great or social proof in some way, that is more likely to use that to scam you. So if you've got an email, they may have loads of reviews on it, and you think, well, that must be good because of those reviews. You've got no evidence they are real. So they'll use that to try and get you to click through on a link, and they can then download some malicious virus on your computer and steal that. Then there is the last two, which are scarcity. So they tell you that something is limited offer.
That is almost always thrown in on a sales pitch towards the end. You know, it's a limited offer. We've got limited stock. Yeah, act now kind of thing.
Yeah, and again, scammers use that because they'll sit there and go.
They're sort of preying on your fear in that. You don't want to miss out, isn't it?
Yeah, you don't miss out. This is only today. The pyramid schemes out there, you know, they will go and say this. You've got to join now because this is a once in a lifetime opportunity you to do this, and there's loads of that with scammers. I think that's probably again one of the bigger ones where they try and get people to rush them so they don't rationalise and think and sit back, because when you sit back you can normally make better decisions when you take that extra day.
Yeah, well, the company I bought my garden furniture on have managed to extend time, because I managed to buy my furniture on a 24-hour special offer. It only ran for 24 hours, and that's now been running 7 days. So 10 days. So yeah, they've managed to extend time.
See, you should be writing to the likes of Stephen Hawking and say actually that stuff you write about, these wormholes and sort of space time and all that.
I found a company that
I actually found somebody who's done it. So, and do you know what? They sell rattan furniture, so it's double win there.
You'd think with that sort of power, they'd use it for some other good. Rather than flogging Chinese furniture and knock off prices.
Like travelling to new worlds like Star Trek, but no, they use it.
Knock up some rattan. Yeah. Well, it's good stuff.
But the funny thing is, it was late as well. Your furniture was delivered.
It was, yeah.
so
it was more than 24 hours late.
So you think they would use that to do a bit of back to the future and make sure it's on time. But and the last one actually, I already covered it, is can't say the word, reciprocating. So reciprocity. What is the word?
Reciprocating and
reciprocity.
Reciprocity.
I think you're doing a better job than me at that one, Andy. But again, if they give you something, you're more likely to give it back. So again, emails, all these things, they will sit there and give you a free gift, and then you feel like I need to reply or something like that. So look out for those. A good game is to try and just spot these things as you get things through the post. You see salesmen when you go in. I went in one the other day, they gave you a cookie in a furniture shop. Furniture, I won't name the company, but you can go and buy furniture, and they give you free cookies and coffee.
Yeah.
And so you go in there with your kids, they love it. Two things, because it gets you there to stay, but actually they've given you something for free, so you feel obliged to kind of hang around and look at a piece of furniture. It's the same tactic.
I go to that furniture shop every Saturday. I mean, free coffee, you can't complain.
Right, that's it for that one, Andy.
Good.
We are flying this week. We've covered so much stuff. That is 3 out of the 4 that we've done. The last one is just really a kind of FYI, because I don't like to date the podcast, but this is something we did feature on a previous podcast. It was a particular bank account that was very popular, and we were asked to do something on it. The Santander 123 account. Mm-hmm. And in a nutshell, it was the account whereby you got I can't forget now what all the 1, 2, 3, but essentially you got cashback, really good interest rates. It was up to 3% towards £20,000, and you ended up getting the cashback rates were the 1 and 2%. So that was the 1, 2, 3. So it was an absolute market beater, and you only paid £2 monthly fee. So Martin Lewis and the like were championing this thing to the point you think they've got shares in the company, but they don't. But it is a good deal. I mean, we talked about it. It's a very good deal, but again, all these things come in cycles. You go back, I think, 2 podcasts, we were talking about the idea, what's going to happen to free banking? Will it disappear and all that? And I said they'll probably up fees and stuff like that. Well, Santander did do that actually back in January. That account went from £2 to £5, but it still represented a good deal because it was that good a deal in the marketplace. Because what people did have thought, do you know what? I'm not going to save in a savings account with that amount. I could just put it in this current account because it's a current account and get a decent rate, get cash back on my household bills if I use that card to pay with. So it was a good product. The problem is they've now realised in the low interest rate world, and we were saying what would happen in that interest rate world in that previous podcast, and basically savers and everybody were going to pretty much lose out. And just to round up, what they've done is they've cut the interest rate. What used to happen before, on the first £1,000 you get a 1%, 2 to 3 grand in that account you'd get 2%, and on up to 20 grand, from 3 to 20 grand you get 3%. That was great. Now they've just gone, do you know what, flat 1.5% everybody, and that fee, like I said, was up in January, and they've also bumped up the overdraft fee. So I'm not quite sure how they're going to call it the 1, 2, 3 account anymore, because by my reckoning it's only about like 1.5, and that's about it. But I'm just checking out there because there's lots of people out there who you took that account, switched to it, check and shop around, see if there's any deals. I'll give you a quick roundup of whether it's still a good deal. The short answer is it is still a good deal, bearing in mind what else is out there. As long as you are using it for the cashback on your household bills, then it can just about make sense. And you need to have about £4,000 in there in the savings to actually get back the £5 a month fee if you work that out. So just a quick throwaway one. If you have that account, do look around, and I don't think you're going to probably beat it at the moment, but it is just shows you that all these deals now are going to start coming in. Savers, you're kind of screwed, to be honest. I mean, I can't put it any other nicer way. The rates are going to go down. The whole point was, like I said before in the previous podcast, the Bank of England want that to happen. If you've got a mortgage, hooray, you're going to be winning. If you're borrowing money, hooray, you're going to be winning. That is just the world we're living in at the moment. I don't think it's going to get any better anytime soon.
Yep, so join up to Damien's 80-20 investor and find a different way to make some money.
Good, Andy. That's a good one. But you can do. I need to be less passive about this and start really pushing the whole 80-20 thing, because we've got a lot of people on there now and it's really starting to fly, and people are getting really into it because you get a free trial. I always give you a free trial, and if you don't like it after 30 days, then there's no problem. You can cancel. But just to give you a clue, most people by far and away never do. So I must be doing something right.
Damien never tells me to say anything, and this is all off my own back. I get the updates that Damien sends for the 80-20. I am a member myself, and it's one of the few sort of businessy related emails, money related emails that I genuinely look forward to getting, because I learn something every time I open that email, and that's genuine.
Do you know, it's good for you to say that, because there are other people who said similar things, and there's one guy I did really laugh. We're getting lots of communication, and we have a chatterbox thing in it where people can write comments and ask questions, and so that's why I was answering those when I was on holiday. And there was one chap who wrote in there saying, do you know what, I never thought I would enjoy finance related stuff, and I spend so much time reading it now, you may actually be named in my divorce. And it just made me laugh, because I love that. That's the idea of trying to get people engaged with money. And if they never were engaged before, and we've talked about it, and I do say it quite regularly, that's what I'm after. I'm after trying to get people to discover something new and a passion, and there's a different way of doing things. You can invest your money, and it is for everybody.
Good. Damien, we've fired through that. It's just over 30 minutes, which is where we like to sort of keep it.
Yeah, the last thing on 80-20 before I will stop, we sent out a survey to all members, and I know a lot of members listen to the podcast. Do complete that survey, because we're asking you what you want me to build, how it's going to evolve. So there are hardly any companies out there that will do that, and with direct action, we always take. Good example, this week I had a couple of people get in touch and say some of the colours, they were colourblind. And it's one of those things that I didn't think but sort of a scale from red to green that's staged. For certain people with colour blindness struggle with like greens and oranges, and so we're able to go and just do that, change that, and make it blues to reds, which sounds like a small thing, but it's massive for the people who have that that unfortunately can't see the differential between those colours, and lots of people out there. And that's the responsiveness, that we can just do those things and we can make changes and stuff like that. So do fill in the questionnaire if you get it, because it will be the service that you want that will come out the other end. So yeah, that's it, Andy. We've rattled through that, but not because there was any lack of content, probably because of my sheer excitement at being back, that I squeeze so much in and talk so quick.
Good. If you want to get in touch with Damien, do so on Twitter at money2themasses with a number 2, or you can get in touch via email podcast@moneytothemasses.com.
That's it, Andy. I'm hoping that was correct, because both you and I were glancing at the Olympics at that point, weren't we? And I do think you said that correctly. So
I did.
You did?
Yeah, I definitely did that time. I had to concentrate so hard, but I did. Yes, we were watching a bit of the triathlon. There you go, a little glimpse behind the curtains. Try and guess what time we were recording this on.
Answers on a tweet. Yeah.
All right, well, until next week.
Until next week, Andy.
Bye.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.